Do not buy an ounce of gold until you've watched this video. In fact, in today's video, I'm going to reveal why it's the worst time to buy gold right now, but I'll show you some tips and tricks so you can time your gold purchases better. G'day, Shay Russell here from Rock Solid Investing, the channel where we like to talk all things rocks and stocks. And today we are going to talk about the shiniest rock of them all, my personal favorite, gold. Gold is going to be highly topical this week because it cracked over $2,000 per ounce on Monday as the US banking crisis rocks and rolls from is it a crisis or is it just a problem that's going to disappear? Now, we don't really have an answer on what's happening yet. It's too soon to come to a formal conclusion on whether this is a genuine systemic crisis or whether this is just the market being a little bit shaky. However, this surge in gold price in US dollars actually caused the yellow metal to hit an all-time high, a never seen before high in Aussie dollars. For the first time ever in Aussie dollars, gold was worth over $3,000 per ounce. Now, it didn't last long. It only lasted about half an hour. However, with the yellow metal trading so high, it does mean that gold is going to start appearing in people's feeds. Now, FOMO is a very powerful thing when it comes to investing, but I'm here to tell you that if gold is appearing in your feeds, it is actually the worst time to buy the precious metal. Take it from me. I've been a precious metals analyst for the better part of 10 years. I've been a long-term gold buyer. In fact, I've been buying gold and silver for even longer than that. So I'm actually going to show you in today's video how you can time your purchases into whether they be physical gold or whether they be a paper gold product like an ETF. Now, my first rule of thumb when it comes to buying gold, and it doesn't matter whether it's the physical or the paper kind, and in fact, we might touch on what those are in another video. But the first rule of buying gold is that you never, ever buy it when it's in the headlines. And the second rule when it comes to buying gold is that if you see gold going up in a straight line like it did at the start of this week, it means it's going to come down in a straight line within a couple of days. Now, there's a reason for this. Now, gold is often called the fear metal, and it reacts before there is certainty in the marketplace. So when you see gold going up in a straight line, it's telling you that there is uncertainty in the market, and the markets actually don't know how to react. However, the price of gold will often come down quite quickly once the markets have been given some certainty. Now, we've got the Federal Open Markets Committee meeting happening this week. Now, that's where the Federal Reserve Bank is going to get together and decide for the second time this year whether to raise interest rates or not. Now, it's highly likely after the Federal Reserve meeting finishes this week that the gold rally will ease and if not reverse and start to head back down. In fact, if you take a look at a gold price chart, you can pretty much guarantee that the gold price is going to come almost back down to where it started after you see a panic surge up. So for this reason, you don't even wait for 24 or 48 hours after the gold prices rallies. You really give it a good 10 to 20 days to see where the price is going to settle before you go and make a gold purchase. However, just because the heat has been taken out of the gold rally doesn't mean that you should rush in and buy the metal. Now, let's be honest, you are never actually going to pick the bottom of the market. And in all honesty, you're probably going to go broke trying to do that. So the third rule of thumb when it comes to buying gold is actually the best time to increase your exposure to precious metals is when you're not thinking about it. Now, I like to view gold, and I know a lot of other people that I've hosted on this channel view gold as alternative forms of wealth. So rather than putting cash aside in the bank each month, maybe consider developing a savings habit of buying gold each month. Like Andy Schectman has recommended, often the best time to buy gold is when you're not thinking about it, especially when it hasn't been in the headlines. However, that doesn't always work for everybody because not everybody can just nick down to their bullion dealer and get some more. Although the good thing is you can buy most of your precious metals online now if you like the physical stuff. If you like the paper stuff, then you can basically buy a gold ETF just like you buy shares. So that's one good way of knowing when to buy gold, when it's not in the headlines. But whatever you do, don't go trying to pick the top or the bottom of the market. You will go broke trying. There's, just when you think gold's hit the bottom, it goes even lower. And just when you think gold's hit the top, it can often go higher. So don't try and chase these peaks and troughs. What you want to do is slowly dollar cost average your position into gold. So just because you paid, say, $1,800 per ounce for one, this is in US dollars, by the way, doesn't mean you've lost money if you pick up gold again at $1,900 US per ounce, because chances are that gold might dip down a little bit below your most recent purchase, and you can pick it up again at $1,700 per ounce. The short point here is that gold is overall volatile, and what it does is it creates multiple buying opportunities along the way, so you can slowly increase your position in the metal over time, and that way you don't get caught out paying absolute top dollar when the gold price is in the news. Now, of course, this is useful information if you're buying gold in US dollars, because odds are if you're paying US dollars for gold, you're buying it in America. But if you're outside the US, chances are you are using your local currency to purchase your precious metals. So, for example, here in Australia, that means that there is the gold price, which we call, or the US dollar gold price, which we call spot gold. And then we've got the Aussie dollar gold price. Now, these are often two completely different things. So with precious metals priced in US dollar terms, but you buying them in your own local currency, it means that you've got to be aware of the currency price movements between the two. Now, these can be daunting for any new investor or any first-time investor to precious metals, as it can be seen as a deterrent. However, I want to introduce you to one of the simplest ways of phrasing it. And once you wrap your head around this idea, it becomes a lot easier to actually time your gold purchases, and it means you're less likely to rush in and buy precious metals just because they're in the headlines. Now, this concept is called the gold quadrants. Now, I didn't come up with this. It came a friend and former colleague of mine, Nick Hubble, who writes over for Fortune and Freedom, put this idea in front of me a few years ago. And I believe that the gold quadrants really simply explains currency movements and what they mean. So first things first. The Australian dollar and spot gold have an asymmetrical relationship. Now, that means there's no neat correlation, but what it does mean is that when you're buying gold in Australian dollars, for example, you need to know the value of the Aussie dollar currency, what it is worth compared to the US dollar gold price, to make sure you're not overpaying for gold at the wrong time. There is actually a sweet spot when it comes to all currency of buying gold, and this is what the gold quadrant helps us understand. So the first gold quadrant is when the gold price goes up and the Australian dollar goes up. Now, what this means is with the Australian dollar strengthening against the US dollar, it essentially slows the gains in the Australian dollar gold price. So what that means is that the gold price in Aussie dollars isn't racing ahead. Now, let's look at it in a different way, the current environment Australian investors find themselves in now. And that's when the US dollar gold price goes up, but the Australian dollar is going down. Now, this is quadrant 2. What this means is it's a rapid increase in the Australian dollar gold price. Now, this exact scenario is why we find there's such a difference between the spot gold price, which is $19.80 per ounce, and the Aussie dollar gold price, which is $2,960 per ounce. Now let's flip that around. So when you've got the US dollar gold price going down and the Australian dollar going up, that gives you big falls in the Australian dollar gold price. Then we're going to get to quadrant 4. Now that's where the US dollar gold price is moving down and the Australian dollar is going down. Now what this does is this cushions the fall in the Australian dollar gold price. Now let's dig into this a little bit more and what it means. So let's go back to quadrant 1. Let's say the Australian dollar is increasing in value against the US dollar. So for in this example, the Australian dollar has risen from, say, 75 cents to 77 US cents. This means the Australian dollar has strengthened against the US dollar. However, spot gold has also increased. When both spot gold and the AUD rise together, it will often slow or keep a lid on any increases in the Australian gold price. Now let's look at quadrant 2. So say you're already holding physical gold and you've got quadrant 2 is like turbocharging your gold investments. A rising spot gold price with a falling Australian dollar will often cause the Australian dollar gold price to increase rapidly. This is exactly what we are witnessing this week when the Australian dollar gold price cracked over $3,000 per ounce for the first time ever. This is quadrant 2 is the last time you want to be buying gold. So as you can see, because the Australian dollar is weakening so rapidly as the US dollar gold price is rising, it means you need more Australian dollars to buy that same 1 ounce of gold. But let's go revisit quadrant 3. Now, quadrant 3, this is your best friend if you are looking to buy gold and your currency is currently strong against the US dollar. When the spot price of gold is falling and the Aussie dollar is rising, the Aussie dollar gold price will often fall faster than the spot price of gold. This is providing an excellent opportunity for you to increase your gold holdings. Over the years, I've actually used quadrant 3 as my chance to increase my gold position. So let's put that another way. That means when I see the US dollar gold price falling, but I know that the Aussie dollar is increasing in value against the US dollar, that's going to drive the Aussie dollar price of gold down. Now, this is the absolute sweet spot when it comes to buying gold in a currency other than US dollars. A weak US dollar gold price, but a strong local currency is your optimal time to increase your gold holdings. Now, let's just wrap up with quadrant number 4. Now, let's go back to our earlier example as well. Now, let's say the Aussie dollar has fallen from 75 US cents to 73 US cents. This means the Aussie dollar gold price has weakened against the US dollar. In quadrant 4, a falling Aussie dollar will cushion the blow of a decreasing spot gold price, meaning your Aussie dollar gold investments don't reduce in value as much as spot gold falls. So what these gold quadrants do is actually help you better understand when to buy your gold purchases. And what you don't want to be doing is buying gold when your currency is weak against the US dollar. You want to be buying gold when your currency is strong against the US dollar and the gold price is falling. That's the absolute sweet spot. Now, those opportunities are rare and they don't always present themselves, especially when you've got competing macro fundamentals in the background, like rising rates, banking crises, and high inflation. But when you do see a high local currency against a falling US dollar gold price, consider that your cue to increase your precious metals holdings. Now, of course, I do advocate buying precious metals as an alternative form of wealth. I treat buying gold as savings. I consider seeing gold as savings at the bank. So while I do try to look for that particular window, as I said, it is infrequent. So I just like to buy gold when I'm not thinking about it. Now, of course, if you like today's video and you want to learn more about gold, drop a comment below and let's see what else we can talk about when it comes to buying precious metals. Don't forget to hit like and subscribe and tick the little red bell to make sure you don't miss another video. Now, before I go, make sure you stick around for next week's video because we're going to talk about silver and whether there's any opportunities for investors in silver. Thanks for watching and I'll see you around.